Today we're talking about tax planning. And specifically, we're doing business tax planning. So, what is business tax planning? It is the act of looking at your income through the year. So, at this point, it's the end of November. If you've been doing your bookkeeping, you should hopefully have at least up to October and a pretty good idea of November. And so, you got 11 out of the 12 months of the year. And the picture of your total income for the year should be almost set in stone at this point. December is kind of a slow year for a lot of businesses just because there's a lot of holidays and off times. So what you got here in November is probably pretty close to what you got. So taking that information and using it to your advantage to see it's like if you can shift income to next year or have more income this year or ways that you can use the tax code to your advantage is really what we're talking about in tax planning here. So one thing about tax planning is that when the year ends, it's usually too late to do most things. So this slow time in December is the perfect time to be looking at your financials and making decisions on that. All right. So tax planning. Before we dive in, let's talk about the very basics of tax planning. Like the very first thing to be thinking about. It's pretty much every quarter, and you're trying to pay taxes on that piece of income for that quarter so that when you get to the end of the year in April of the next year, you don't have this big sum of money. And what I see a lot of times from business owners is that they're used to having a job where it's a W-2 and it's being withheld. And they start this new enterprise and hopefully things are going really well and you have a lot of income. Unfortunately, paying the estimated taxes is not something that they're always thinking about. So what will happen is that they'll come to me and it'll be like March or April and we'll file their taxes, we'll get everything together and they'll have some big number. And like you did great, your business did wonderful. Unfortunately, you're gonna owe a little bit of taxes now, and that's bad in two ways because A, you could have been paying estimated taxes on that and you wouldn't have this big lump sum. But B, you came to me in March and April and a lot of times it's too late to go back and do things for that past year. So doing tax planning in these last couple months, November and December, is really key. Okay, so one thing here. So one thing about tax planning. A lot of CPAs, when they say, oh, you have a big year, is to go out and buy some like car or a big piece of equipment. That's something that I don't necessarily like to suggest right off. I joke about accounts that can't add because sure, going out and buying a piece of equipment could lower your tax bill. However, if you don't actually need that equipment, let's say give you a real world example for me. I do taxes. It's exactly what you think. It's a lot of office work. I got computers and things, right? But what if I went out and bought like a big drill? I don't need a drill to do accounting, right? And let's say it's $100,000 drill. So awesome, bought a drill and I lowered my taxes. But now you have this unnecessary piece of equipment that you spent $100,000 on to lower your taxes, and the tax benefit maybe be like 25% of that. So in my example, let's say that I had $100,000 of income, but I had the $100,000 deduction from the drill. I spent $100,000 for the drill only to save $20,000 or $30,000. So that's one thing that you say go out and buy equipment. Make sure that you actually need that thing, right? It it doesn't make sense to go out and buy things just to lower your tax bill because you're spending a dollar to save 30 cents. And I mean, if you need it, awesome. Buy it. Go out and do it. But if you don't, sometimes the math just doesn't math right. All right, so let's talk about some specific year-end things that you can do. So when you're talking about expenses and the best way to save money, the first thing I look towards is how do I not spend money and then save on taxes? And that can come in a few different ways. The first way is going to be looking at things like retirement accounts, things like 401ks, SEPs, things like that. Always the first thing, in my personal opinion, are the best way to save money. So things like a great example for 401k. You can get a deduction for putting money into your 401k, a solo 401k, usually very cost effective. You put money into the 401k, you took money out of one bank account and you put it in another, and you still are saving on taxes. To me, that's a win-win. And yeah, you could make the case that you don't have access for that. You don't have access to that money if you take it out as taxable, but you really should be saving for retirement anyways. So it's a win-win, putting money into retirement while also saving on taxes. Anytime that you can do that is going to be a big W. Some other things too. I know I just had a big rant about this, but things like equipment. If you're going to buy that equipment anyways, but maybe you would buy it in like February or March because it's maybe something that you need, right? And this could be the same for inventory. So if you're a cash basis taxpayer and you know you're going to have to buy this piece of equipment and you've had a really big year, your income is really high and it's not going to be as high next year, or you're just trying to lower your tax bill right now at whatever cost, buying that piece of equipment now instead of next year can make a lot of sense. One thing that's nice, we're kind of getting into those last years of the Tax Cuts and Jobs Act. Equipment can be new or used. So even if the equipment is used, you buy it from other, Facebook lot, you buy it from like Facebook Marketplace, Craigslist, something like that, you can still take the full deduction through bonus depreciation. Some other things you can do too, these are things that typically require having employees, but I mean, if you're going to spend money, at least put it in your employees' pocket and make them happy. That's going to be some of the next things. Okay, so we got Sherry Lucas. What kind of things need to happen before the end of the year? So you're talking about like how to prepare for your taxes, or like what moves specifically, right? So let's just talk in general here. To prepare your taxes, you're going to need to do a few things before, well, I guess it probably doesn't need to be before year end, but if you haven't taken your books and made financials, put them into categories like revenue and expenses, right? Really broad categories are going to do fine for this purpose. So put everything into like revenue, money coming in, then have all of your expenses like supplies, equipment, things like accounting fees, legal fees, whatever. So broad categories, generally you don't want to have more than like 10 or 15. See what your expenses are, and that's going to be one thing. That's going to give you an idea of what your net income is going to be. Revenue minus expenses is going to be net income, and that's actually what's taxed. So once you have that piece of information, quarterly payment is due in January of next year. So ideally, if you've gotten your net income and you haven't made any estimated payments yet, first thing you want to do is get that paid first, so you don't have any estimated payments penalties. Beyond that, there are some things to take a look at, and that's what we're talking about here, as far as expenses that you can take now or later. If you're having a really great year, you want to start thinking about taking expenses now instead of later. If you've had a year that's not so great, you want to think about pushing expenses off until later as far as you can. You want to take the income now, right? So, Sherry, hope that answered your question if you have a follow-up. But back on the question of some of the expenses that you can take. And these next few are things like you'd have to have some employees. And typically, if you're going to spend money to save taxes and it's not on yourself, you might as well go to your employees. So things like cell phone stipend is something that you can take a look at. Dependent care is something you can pay for. There's a couple different ways you can pay for employees' dependent care. Education is another one. And you could pay for yourself education as well. So I myself am a CPA, and I have to have so many hours of what's called CPE, Continued Professional Education. I always forget what it's called. But I'm required by law to have 40 hours of it. So constantly thinking of looking for ways to get 40 hours, and it's not cheap sometimes. Sometimes you got to go above and beyond. So that expense is going to be deductible for the business. So if you need to send your employees to some sort of conference, or sending yourself to some sort of conference or education, having someone come and educate your employees on like a process or something like that, that's a great way to use that deduction. Some other things are going to be things like inventory. This is really similar to things like expenses, or excuse me, expenses. Well, expenses. Inventory is a lot like equipment. You don't necessarily want to buy things for inventory that you're not going to use. You want to make sure that you're buying inventory that is actually usable. Otherwise, you're spending $1 to save 20 cents, right? So a great example, I see a lot of like bakeries, things like that. If you know you're going to need the flour and you're looking for ways to save or lower your tax bill now, you can buy a little bit more flour this year at ingredients like sugar or whatever. And that's a way you can have more expenses now and not have so much next year. Sherry has a question again. You mentioned that in March, some things couldn't be done for the prior year anymore. Yeah, so if you think about it, when we're still in the year that's being taxed. So next year is you're filing your 2022 taxes. We're still in 2022. So when 2022 is done, it's too late to buy expenses in 2023. So that's really what I'm talking about, and doing a lot of these things like contributing to a 401k might be too late to have one established. Things like 401k, great example, you have to have it established by year end. Doing the work now before the year end while we're still in the tax year is going to be the easiest way to get these expenses than waiting towards next year when we're in 2023. There's not a whole lot you can do about 2022. So there's some things you can do, like you can still contribute to, assuming that your 401k is established, you can contribute to it up to like April, I believe. I know for sure the SEP. And then there's some retirement accounts that if you extended up until October before you file. So that's what I'm talking about when we talk about March. I mean March of next year. What's the best way to reduce my taxes for next year? I read that I'll be paying more. So the best way to lower your taxes now, speaking from a business standpoint, is to look at ways to bring expenses into the current year. So like I said, if you need to buy equipment, buying it now instead of in 2023, or buying more inventory or having more expenses. Another great way with the expense rules, if you can work it out with things like your landlord or insurance. I'm sure they're always looking for ways to take your money, but if you pay for an expense like rent, and assuming that your rent doesn't go beyond a year or the end of next year, and you pay for it now, you can take that deduction this year, even though a majority of it may be in the next year. So that's another way that you can take advantage of the tax code and lower your taxes this year. It would be, I forget the exact name of the rule, but it's like the 12-month rule. So looking for ways to bring expenses in now and then later. Some other ways, if you're just a W-2 employee, you don't own a business, or even if you do own a business, it would be for things like contributing to a 401k. You can contribute now to those. And if you have a 401k at your job, you can increase your contributions to that 401k, assuming that it's to a traditional 401k, and you can increase your contributions, and that's a good way that you can save on taxes now. If you're to the point, if you have a job and your employer is giving you a match on your 401k, if you're not putting money up to at least that amount, you need to. The very minimum, if you're not doing anything, because it's free money. So make sure you're getting that employee match. So that's the best way. Another way, it's not going to lower your taxes, but if you believe that you're going to owe more, you can withhold more. So you can fill out a W-4 with your employer and have them withhold more from your paycheck. And you can also make estimated payments online. So it's really easy to make payments online. It's irs.gov/payments. And you can make online payments that way. Some other things that you can do, some other expenses to think about would be gifts. Right now is we're getting into December. So client gifts, employee gifts, there are some special rules for that. It's $25 for each individual that you give a gift to. So when I was at a larger firm, a great example, we gave all of our clients a bottle of whiskey. I remember I drove around and delivered the bottles of whiskey to the clients. That was a lot of fun. The problem with that is that the whiskey probably costs like $50 or $60. You're limited to $25 a person. So keep that in mind if you're giving out business gifts. And that's not an item per person. That is a year limit. So if you're showering your clients of gifts every year thinking you're going to get $25, that's not the case. Also, some things, and this is kind of like one of the gray areas in the tax code. This has a tendency to get abused. I'm not saying that you should abuse it in this way, but travel expenses. There was a talk on a famous accounting podcast. I'm sure everyone listens to accounting podcasts like me, but a CPA had mentioned that you can go to a pumpkin patch and ways that you can take your kids and travel out of town to the pumpkin patch and have all of your expenses deductible. It had a bunch of ways that you could do it. That's abuse. It's probably not a business expense. The way that you would take advantage of that is if you had, let's say, so little backstory, my family, I grew up in North Texas, closer to Dallas and Fort Worth, and I live in Houston. Let's say I went to a conference in Fort Worth, and I was at this conference for 3 days. In the meantime, let's say one night I went to my hometown, Wichita Falls, to see my family. The part of traveling to Fort Worth and all the deductions there are still deductible. So you can still take advantage of traveling and take a vacation. A really great example is going to places like Disney World. Sometimes Disney World is a place that likes to do a lot of like events, like a lot of conferences. If you went to Disney World and let's say that the conference was like 3 days and you happen to spend 2 days at the park doing, Disney World things, that trip is still deductible. You can take the travel to and from Disney World as a deduction. Excuse me. And it kind of doubles as a vacation. If you take your spouse and your kids, you have to piece out the pieces that are for your kids. So, and also your wife, assuming that she's not an employee. So, plane tickets for your spouse and your kids aren't deductible, but in that situation, any kind of travel expenses for yourself are. So, hopefully your family is at a conference place. I don't know how many conferences are around Christmas time. But if there happens to be a way that maybe you'd look at taking that trip and to a conference and then seeing your family that way. One thing about expenses is that they need to be ordinary and necessary. One thing that tends to be abused is a lot of like meals expenses. Going to the most fancy restaurant, like the fanciest restaurant to speak with the client, probably isn't going to be in that category. It's probably not going to be deductible just because it's so lavish. I mean, you can make the case like if you're doing that all the time, maybe it is. It's a lot to spend on for only 50%. Most years it's 100% this year. So it has to be ordinary and necessary. Back to the example of the CPA firm buying a drill. Most CPA firms probably don't need a drill, so probably some questions there as to actually if you need the expense. So just buying things isn't going to count. So really, the main thing to think about with tax planning is to think about if you've had a really great year, if it's going to be one of those years where you just knocked it out of the park and next year may not be so as great, looking for ways to take deductions now. And if you had a bad year, looking for ways to push expenses and income. Take the income now and push the expenses away. That's the main part. Always be thinking of paying your estimated taxes. If you get to the end of the year and you haven't paid any, there's a good chance that you're going to pay penalties if you owe that lump sum. So paying a little bit here and there is can't hurt. And just FYI, I'm going to have a Facebook Live event at the same time every night, or not every night, every Tuesday night at 7 p.m. until the end of the year. So the rest of December, I will be on Facebook Live answering business tax questions. So tell your family, tell your friends about it. I'll be here every Tuesday night at 7 p.m. to answer your questions.